Evening again, everybody. Appreciate your time tonight. We're really excited to talk to you about our latest acquisition. We've been working with the seller recently, and we actually are acquiring this off market, meaning this was never blasted or sent out on a list or anything. And there are many reasons for this, but she's asked us to keep the name of the park confidential. So we've actually been now referring to this as the Southern New Orleans RV Park. So you'll hear us talk about it that way. We will be talking about the location. As we get a little closer to closing, we'll be able to disclose the actual name and address and all of that information as well. But to respect the seller's information, we'll just keep this a little confidential for a little bit longer. Just quick reminders. We use the Zoom Q&A feature. It's a really easy way for us to make sure that we're answering all the questions. So if you have questions, please put them in there. We'll answer all of them by the end of the webinar, but there may be some that we'll take during the webinar if it's contextually appropriate or a good time for that. And then what we'll do tomorrow is we'll send out this recording as well as the full deck and notes for the Q&A portion as well. So we'll have all that. Just a quick legalese here. This is a confidential private placement offering, and it is actually a 506B offering, which means that we are filing this with SEC in a way that we are able to offer to accredited and some non-accredited investors. So if you are interested, definitely let us know soon, because especially those non-accredited spots, we only can do so many and they usually fill up pretty quickly. So let us know. And if you have friends that are interested, totally okay to talk to them. Just make sure we're in the loop, because we have to be, especially on a 506B, we have to have a relationship with anybody that's interested in investing. Okay, so our agenda, we're going to talk a little bit about Suncrest, make sure everybody knows our background and why we're really excited about this park and why this is a perfect fit for us. We'll talk about the park itself, the asset, the market, all that kind of fun stuff. I'll take us through the investment strategy, the return profile, what our performance and projections are, and we'll finish up with the partnership structure. So with that, I'll let Matt talk to us about Suncrest.
Yeah, okay, yeah. I'm going to give the team here, the group here, a little bit background about Suncrest. So essentially, we work to identify and invest in undervalued commercial properties. And we have one here today that I think that we're all pretty particularly excited about. We manage these properties in-house and typically add value through creating operational efficiencies and creating different types of upgrades to the properties. And then ultimately, it is our mission to deliver generational returns to investment partners by fostering safe and attractive properties where residents and business owners are proud to live and work. That's our internal mission. Next slide, please. So this is our team. Brett Bowman and Ryan Hill. They co-founded Suncrest several years back, and I met them shortly after they started working together. And I began investing in them and ultimately their deals. Now we kind of tackle these new opportunities together, just like this particular deal. Together we have little over 50 years of real estate investing experience between us. And I think that we do a good job like combining our individual strengths and knowledge the best way we can, once again, to ultimately provide good returns to our investors. But in general, Brett, he kind of focuses on the legal, finance and acquisitions. Ryan leads all of our operations of our properties, and I focus on underwriting many of our new acquisitions, as well as supporting the management of our assets. Next slide. Our team expands way beyond the three of us. We have Kristen and Doug Hensley. They lead projects for us that support all of our commercial properties throughout the Midwest. Kristen heads up and is responsible for all of the projects that we have going on in our mobile home and RV parks. And I would say she does that in addition to many, many other things. And Doug leads he leads many of our home rehab projects in our mobile home communities. Next slide. We also have Allie Larson. She leads the home sales coordination side of the business, from ensuring that homes get to our communities, ensuring the parks are prepped and ready for bringing in new homes, and ultimately selling homes. And I'd say Tripp is kind of our invaluable utility player. He supports all of us with up-to-date financial analysis of all of our current properties and any new acquisitions, ultimately, so all of us can make the best investment decisions possible. I'd also say, kind of not captured here in this presentation, are kind of a network of other regional managers and managers that we have in our mobile home and RV communities as well. Next. So the next 3 slides, they really like kind of depict some of our past investment opportunities and portfolios that we'd offer. These describe, within these slides, it describes some of the value that we've added while owning and managing all of these properties. I'm not going to go over each one, but Brett eventually is we're going to share this presentation with all of you, and you can feel free to read those once you have the deck. So with that, I'm going to pass it on to Ryan.
All right, thanks, Matt. So the majority of our properties under management are in the Midwest, so Kansas, Iowa, Missouri. The ones up in Sun Valley, Idaho, are closer. Brett and I are based out of the Boise, Idaho area. So we have some connections there. Mostly we like to buy and add to portfolios. The Southern New Orleans RV Park is this newest acquisition that we're excited about. It'll be our 24th property under management and our 3rd RV park. So we have an RV park right now in Fort Scott, Kansas, that we've been managing for some time, and then our newest one before this is Sweetwater RV Park in Sweetwater, Tennessee. All right, Suncrest, we have a strategic layered vertical integration for management, sourcing deals, buying and selling homes across our entire portfolio. So some of these things won't equate exactly to this one because we don't have mobile homes in this park or bringing them in, but just wanted to make you aware of how our vertical alignment works. So we have our own home transportation scheduling team to control the timing of our home moves in our other communities. We own our own dealer entity to sell homes through a variety of finance options to our tenants. And like I said, it's not as applicable for this one, but it helps streamline our processes so we have efficiency with our staff. We've also developed our own US-based cold calling team. We've sourced a few properties that are currently owned in our fund, which will also have ownership interest in this new acquisition. We have several broker relationships as well, where we're able to source deals that haven't hit the broad market. And this RV park is an example of that, where the broker came straight to us with the deal. And then as well as our last Missouri 2 offering, it was a 6 property portfolio sourced the same way, with off-market relationship with other owners and dealers.
All right, so I'm just going to give a kind of a quick overview of this kind of Southern NOLA RV park. I guess I could say that this property it's simply the best mobile workforce housing / camping site that's south of New Orleans. It's really, ideally located in this area stretching from Belle Chase to Venice. And in a couple minutes here, Tripp's going to talk a little bit more specifically about the geographic area and some of the industry around it. Currently it's 100% occupied by people who work in dozens of these factories serving the oil and gas industry in south of New Orleans. Currently it has 92 sites, and by the time we close, it's going to have 97 sites. All of these sites are supplied with free water, electricity, in addition to free Wi-Fi, free DirecTV, and all of the people who stay there have access to a fairly new on-site coin-operated laundry. As far as the infrastructure, the electrical, sewer, and water is basically only about 3 years old. And our plan moving forward is to continue to work with the staff at the park and all of the associated vendors to ensure the operational efficiency, as well as the park is kept up well, because quite frankly, it's pristine right now. This is it's a fairly turnkey operation for us, although I would say that we do recognize that in a property like this, providing like great customer service is a must for this property, and it's going to be a priority for us as we continue to operate this park. Moving and kind of looking into the future a little bit about this, and kind of how we went about underwriting it, and Brett's going to get into more detail on the investment returns in a couple minutes, but I do want to touch on how we went about underwriting this property and give a little sneak peek of the returns. As I mentioned before, this park is fully occupied, and with 100% occupancy. However, from day one, we're underwriting this property with a 6% vacancy loss. That's essentially a little over 5 spots being empty all of the time. The laundry is a cash business. The owner suggested they collect like an absolute minimum of about $2,000 per month in revenue. So we used the minimum, whether they were saying they collect $2,500 to $3,000 per month. Another way that which we have like kind of conservatively underwritten this property is currently the property taxes here are about $1,300 per year, and upon sale in this area, properties are not reassessed. So we are going to assume that tax rate starting day one. However, we know it could potentially be reassessed at some point. So as we've underwritten this, we've assumed a $10,000 tax bill starting from day one, counted into our expenses. Also, the park currently pays around a $3,800 insurance bill, and we've assumed an insurance cost of $35,000 per year. That's 10 times what's currently being paid. I would also say that when we look at this park, there's not a lot to fix going in at all. There are really no major renovations needed for the park. However, each year we're setting aside over $25,000 as a replacement reserve. So all that being said, after year one, we expect an NOI of about $700K, with some moderate rent increases over a 10-year period, ultimately getting us to about a $1 million NOI. The plan is to refi this property at around year 5, and if we consider like a pretty conservative 8.7 cap, we'd be able to return all of the capital invested from our investors at that 5-year mark. And with a sale at year 10, again, considering around an 8.5 cap, this would result in an overall IRR for investors at about 19%. And then ultimately, it would also result in an equity multiple of about 3x over a 10-year holding period. Again, Brett's going to talk a little bit more about some of these returns in just a couple minutes. And with that, I'm going to turn it over to Trip to talk a little bit more about the location and the market down there in just south of New Orleans.
Thanks, Matt. So I think where we'll begin is, as you see, the first thing that most likely catches your eye is our higher than average market rent here. And I just kind of like to touch on how we justify that and how the Southern NOLA RV parks kind of come to this lot rent. So as you see here on this little red RV sign, that's currently Southern NOLA RV Park. And just south of that is a historic floodplain. So from that marker all the way down to Venice has historically been privatized levees. What that means is any tropical depression, any hurricane from that RV park down to Venice, you can most likely guarantee there's going to be significant damage. There's not going to be, the regulated levee. It's not going to have the right support, the right height, and it's just kind of devastating damage. And so because of that, what we see there is most likely, we're more than often fish camps, lots of red fishing down there, and really kind of low income housing. And after Katrina, there were some bureaucrats that got together and lobbied the Obama administration, got some federal funds, and now that levee is completely federalized for that 28-mile strip. And as soon as that happened, all the big players came in. We're talking industrial plants, construction, LNG, and not to mention transportation terminals. We're right alongside the Mississippi River here, which is one of the greatest commerce routes in the United States. And so as soon as that levee got federalized, it opened up the door for these big players. And so there's not a lot of small development going on down here. What's there is there. But really, we're seeing a lot of development. As you can see at the bottom, Venture Global LNG is building a 164-acre, multi-billion-dollar plant there, right alongside the Mississippi. And Kinder Morgan's got a transportation terminal a little bit further north. And then just south of the Southern NOLA RV Park is the Phillips 66 refinery. If you look more to the center left, you'll see a little red portion that says current development. On our due diligence trip, as we were driving south, you look to the right, it's just all massive construction. They're even kind of reclaiming land that's now marsh, and they're bringing in millions of tons of sand to reclaim that land for even further development. And what that does is that's going to create jobs for us. And that's also going to kind of keep out the small players. Like I said, as you can see, there's a few RV parks down south, and they're run down. They're, weeds and trash and garbage are just minor issues there. It's not ideal for these long-term cyclical workers that have these really good stipends from these major companies and want to come back after a long day's work and relax. Not only that, but the Southern NOLA Park is situated right in the gateway of New Orleans. And so what we're seeing is that rather than, I'm sorry, I've lost my place here. Let me see here. It's really, when you go down south, like I said, it was mostly fish camps and these major players. There's no goods and services, hardly, maybe a gas station or two. There's no banks. And really, if you want any amenities that come along with the metropolitan area, you're going to have to travel up north to New Orleans. And that's the convenience of the Southern NOLA Park. And I think Matt also touched on it, that it's the turnkey character of the park, and that goes along with the vetting process as well. You drive there at night, there's no sound. It's people sitting on their porch by a fire or getting rest for a long day's work. And just one more support item. This park has had consistent 100% occupancy with 5 to 10 person wait list year over year for the past couple of years. And they've really kind of keyed in on that lot rent price by increasing, and then they maintain 100% occupancy, increase again, maintain. And it's kind of the philosophy that if you have 100% occupancy, you still might not be priced just right. And we can continue on to a little bit about Belle Chase.
Thanks, Trip. Just real quick, there are a couple of points you made that I wanted to reiterate, just because I think this is a super important slide. So one thing Trip mentioned is, hopefully you can see my cursor. We've got our RV park is here in red. Just below that is the floodplain, meaning we're not in the floodplain. So that was a huge thing for us to make sure we understood. That's a big impact to insurance if you're in a floodplain. So not only is that increase your operating expenses, but it also can make it challenging to sell later if you're in a floodplain. So that's one of the values that we have here. But the other thing is, really the only opportunity to develop is along this corridor, because everything else is marshland or ocean, obviously. And so to Tripp's point, that's why this is just the perfect location. It's about as close to New Orleans as you want to be if you're one of these workers, and it's as close to the plants as you want to be if you want to be able to get to New Orleans and get those amenities. So just kind of perfect world.
Thanks, Brett. And just a little bit about Belle Chase. It's kind of one of the historic towns in Louisiana. Its lifeblood is founded in these industrial plants and really just shipping, right along the Mississippi River there. They've also got a Naval Air National Guard station here to boast. And just a few key points. It's 10 miles south of New Orleans, about 10K population, and it's seen about 2,000 increase year over year since 2020. But this was just from the 2020 census data. And as far as real estate goes, it's grown about 11.4% year over year. And again, I think that's really the location. It's kind of the doorway to New Orleans. Belle Chase is as well. And then all the incoming industry and job growth that's anticipated. So just a really nice place to have a business. And I will hand it off to Ryan.
Yeah, just building upon what Tripp was talking about with growth and development in the area. Plaquemine methanol plant. It's a newer plant that's being developed in Plaquemine's parish. Castleton Commodities International, they received an air permit from the Louisiana Department of Environmental Quality for that site. And it's just opposite Belle Chase across the river. The company's plan, which was announced back in 2014, involved construction of a $1.2 billion plant in a former Amex nickel site. Capacity to produce 5,000 tons of methanol daily, creates 50 jobs. Methanol, if you're not familiar, it's used in a variety of chemical processes, including plastic, polyester, paint production, also as a fuel additive. So always needed for many different things. And then the Belle Chase Bridge and Tunnel Replacement Project, that's to just improve the infrastructure in up and down that area. But the project will replace the existing bridge and tunnel with a fixed span 4-lane bridge. Replacement of those structures will allow for safer and more reliable access for residents, businesses, industries, and the Plaquemines parish. It improves the connectivity via the corridor to address current conditions, operating constraints, creating by aging infrastructure. And it's set for completion in 2024 in the spring. And the last point there, the U.S. Department of Commerce Economic Development Administration, they've granted $4 million to Plaquemines Parish for water infrastructure enhancements aimed at safeguarding businesses against future natural disasters. The grant matched with over $1 million in local investments, anticipated to generate 625 new jobs and help maintain 6,000 existing jobs. Yeah. We realize there's likely many of you on here that have questions about hurricanes and large storms that come through the area. We know this. We know storms will occur. They have occurred in the past. They're going to occur in the future. In previous storms over the last few years, the park has really had no damage. They've evacuated the RVs successfully. No damage to the infrastructure. Anybody that was in there, any RVs. The laundry room, as Matt alluded to, it's built in a steel Connex box, and the majority of the infrastructure is underground. There are some overhead power lines, but most of it is underground. The internet and satellite TV connections are also housed in a steel Connex box, which they're all raised up off the ground as well. And then to add on a little bit of what Tripp was talking about before, after Hurricane Katrina in 2012. The Army Corps of Engineers, they entered into a significant agreement for $1.4 billion worth of new work to improve those substandard levees in the Plaquemines Parish. The levees, which had caused issues for years during storms, they'd be overwhelmed with even a mild tropical weather, obstructing vital evacuation routes. So The agreement entails federalized money for the non-federal levies, raising the height fourfold. So really quite an increase in height for those levees on both sides of the river. And that provides a 50-year protection along 60 miles on, again, both sides of the river. The initiative also includes improvements to 7 pump stations with frontal barriers. You can kind of see it in that bottom left picture. That helps prevent inundation from storm surges. And so the initial phase started near the Ollie pump station, which is just below Belle Chase. So, improving the 60 miles, it's secured, it's backed by secured funding, ensuring that progress will continue even if there's government shutdowns, things like that. That work is still in progress today. So our side, to help reduce and mitigate the potential damage of those storms, like it just mentioned, with the levees have been raised, that helps reduce it. We will have mandatory evacuations during hurricane warnings, just like the current owner does. Just make sure all of the residents are safe. Simple storm resistant infrastructure, and we're really going to be overinsured on this property and everything in and under it.
Thanks, Ryan. So transitioning over to our investment strategy, of course, my favorite topic. Some of these numbers have been shared in our email already, so hopefully this isn't completely new. But we always are fine tuning our underwriting and assumptions, and here's where we are at this point. So our investor IRR is going to be just shy of 20%, 19.7%. My favorite part about this assumption is Matt kind of talked to before. We're assuming a super high cap rate of 8.5%. Really, something like this that's 100% occupied in a massive metro like New Orleans should be trading more like a 6.5 to 7 cap, even with an RV park. So 8.5 is extremely conservative. We're looking at a 10-year hold. This is the type of park that could flip faster than that in like 4 to 5 years potentially. But at this point, we really like the idea of a 10-year hold. Again, I'll show numbers here in a second. Matt also explained that our plan is to refinance in 4 to 5 years and pay back all capital, and then you'll still continue to receive distributions after that. And then when we sell, you'll receive a lump sum of the sale proceeds as well. We'll do a 9% preferred return beginning within the first month. You'll receive 6%. So the way that works is the preferred return is 9%. We'll pay 6%, and then that remaining 3% will accrue. And so before we can pay out any distributions to managers or general partners, we have to catch up on that full 9%. So that is as guaranteed of a return as it gets. And our expectation is the first few months we'll be paying 6%, and we'll take the remaining 3%, 3 to 4% actually, to use for reserves just in case there's any kind of repairs that come up that we're not aware of. And then pretty quickly, we expect to get to 9 to 10% within even the first year. And again, I'll show you our projections on the next slide. As far as distributions above 9%, we are doing 60% to investors and 40% to sponsors. So what that means is, again, the first 9% comes to investors, and then above that, we split 60-40. So if there's 10% returns, for example, investors will receive the first 9%, and then that final 1%, investors will receive 0.6, and sponsors will receive 0.4. So that's our first time getting cash flow that way. And then we're also introducing a new asset or a new share class B share for anyone investing 500,000 or more. It'll be 65%, 35% split above that, above the 9%. And then we are going to be doing monthly distributions beginning within 1 month of closing. So again, I think it's pretty rare to see monthly distributions, but this is something we've done with all of our assets, and we've always had our investors really happy with monthly versus quarterly. So looking at the cash flow projections, we always estimate this based on a $100,000 investment, just because it's easy to extrapolate it to a higher number if you're planning to invest higher than this. So for the first year, our actual cash flow, we're projecting to be about 10.4%, but we've put on here 6% because, again, we expect to reserve the difference for any kind of repairs that might come up, and just kind of be conservative. So once we feel comfortable with the asset and know where we're at with our cash flow, we'll open the floodgates and increase to our true cash flow quickly. So again, we expect within the first year to be paying out to that 9 to 10%. So 6% will hit first month. So in your first year, you can expect to receive at least 6,000. Should be more than that as we increase the preferred return. And then each year after that, you see that we're projecting 10, 11, and 12%. In year 5 is where we have our current refinance. So you'll receive your full investment back of $100,000 in this example, plus another $11,000 in cash flow. And then after that, best part about this is you've been completely de-risked because you no longer have any money invested, but you're still receiving $4,000 in cash flow, 5,000, 6,000. So obviously it increases from there. In year 10 is where we projected to sell. And in this scenario, the pro rata ownership of this investor would be $126,000 again. And that's again, after having received cash flow every single year, every single month, really, having received all of your capital back in year 5, and then getting another 126,000 in year 10. So pretty sweet from that perspective. We always like to share our pro forma. Again, I'm going to be sharing this whole deck tomorrow, so you can kind of look through this line by line. But there's a few things I wanted to show here before moving to the next slide. The first is you can see from our effective gross income, we don't actually project. Oops, sorry, I didn't advance slide. We don't actually project a huge increase in effective gross income year over year. We're just doing moderate rent increases of about 4% every year. We also have a healthy vacancy loss baked in of about 6%, even though the sellers currently are not seeing any vacancy loss. And then we have a high salary that we've added in here for payroll. The sellers currently self-managed, so we expect to have obviously some increase in expenses. We hire an on-site manager, maybe some maintenance people. So all of those things have been baked in. So we see fairly high expenses that we're baking in, about $350,000 in the first year. So total net operating income is about $700,000. This is very conservative compared to what the sellers have already been experiencing. My favorite part about this underwriting is that our debt service coverage ratio is over 2. We've never modeled something that's been over 2 before. This is the highest debt coverage ratio we've ever had. So what debt service coverage ratio is, it's essentially net operating income divided by your debt service. And it's a ratio that banks use to see how much cash flow you have. And most banks require anywhere from 1.2 to 1.35 before they'll finance you. And we're well over that. So there's a huge margin of safety on this one from a cash flow perspective. Moving to the partnership structure, this is again a lot of numbers, but we like to just kind of explain where we're at with some of the fees, as well as just reiterate some of what investors will be receiving. So our acquisition and loan guarantee fee is 2%. We have an asset management fee that's 5% of effective gross income. That's actually shown on the pro forma that I just showed, and it's below net operating income. We have our members preferred return of 9%. Minimum investment $50,000. And then as a 506B offering, we're doing, this is for accredited investors and a limited number of sophisticated non-accredited investors. So again, if you're interested in that, please do reach out to me as quickly as possible, because those usually fill pretty quickly. And then on the right side, this just kind of breaks down what the equity ownership percent would be based on a $100,000 investment. Sorry, I'm looking at 2 different monitors. I just realized I was completely explaining the wrong slide. This is the partnership structure that I just walked over. Very, very sorry. Again, we'll have this deck exported tomorrow, so you can review this at your leisure. On the budget side, so we have the bank loan is going to be 4.1 million, and then we're raising 2.65 million for a total budget of 6.7 million. On the right side, you can see our purchase price is 6.4. We'll have 120,000 in operating reserves. Our closing costs, this is just a ballpark. We're estimating about 128,000. Legal and third-party expenses, 32,000, also an estimate. And then that 2% of acquisition and loan guarantee fee to sponsors is 128,000. So as far as next steps, we're looking for commitments by within about 10 days. So commitments are due August 25th. You can do that either through Syndication Pro, which is our investor portal. And you can access that by going to our website, suncrestgap.com, and clicking on invest. You can also just email me. My email's on the next slide, or you can reply to the email where we send out all of the information about the webinar. Those are all great ways to reserve or make a commitment. Funds are due on September 15th, and then we'll be closing September 25th. And you can expect your first distributions on or before the month of November for that 6% preferred return. So with that, we'll go ahead and open it up for questions. Okay, so I see one question. How far away was the flooding from during Hurricane Katrina? So let me see if I can open up our map again real quick and talk a little bit better. So the brunt of Katrina came in straight through New Orleans up through this northern part of New Orleans, and Bella Chase, Plaquemines Parish is down here. So it missed the brunt of it by about 10-ish miles, but certainly had flooding. But based on the construction of the park, the flooding was gone within a couple of days. So certainly something that would have been impacted by Hurricane Katrina. So that's where everything we mentioned before on that other slide, all of those contingencies come into place on that to protect us. Okay, next question. Can you get regular insurance and FEMA insurance on the property? Yes, we have. Actually, Ryan, I'll let you take that question because you do all of our insurance.
Yeah, so the insurance quotes that we have are for regular insurance, and they're well below what Matt and Brett were describing within the underwriting. So I think we've been bullish on that. So the FEMA insurance, because of how the levies, the federally funded part of increasing the robustness of those levies, that's a possibility as well.
Okay, so the next question is financing terms: source, rate, fixed or variable, prepay, penalties, etc. I'm actually starting to type that answer so you can see that in Zoom in a moment to see more specifically. But our details are: it's a 30-year amortization. The rate, we've actually got it fixed and locked in for 5 years at 7.85%, which I know some of you are balking at. It's a high rate for sure. It's about triple what we were getting 18 months ago. So it's a high rate. However, we looked at lots of banks, and this is about a full percentage point lower than the next lowest. And part of that's because we're using the same bank we used in the fall with our large Springfield acquisition. And so we have a good track record with them. So they give us a little bit better rate. Also, the amortization is helpful, and we are getting interest only for the first year. So we're loving fixed rate debt right now. I mean, honestly, we've always had fixed rate debt. Every one of our properties, we make sure we have fixed rate debt. This is a 10-year term. It's fixed for the first 5 years, and then after year 5, it'll reprice to the prevailing rate if we still have it. We can refinance after 3 years with no penalty. In the first 3 years, it's a 3-2-1 prepayment penalty, which means it's a 3% fee the first year, 2% the second year, and 1% the next year. Okay, the next question is what kind of mortgage is that? So hopefully, Mike, I see you said thank you. So I think we're good there. Okay, what other questions do we have?
Brett, there was one at the top about, why is the seller selling? And essentially it's a mom and pop operation. A husband and wife have been running it for the past several years, and they're ready to retire. They want the windfall of money through this sale to be able to buy another home in a different part of the country. So they're looking to cash out.
Yeah, honestly, this seller, they've done a really good job of buying right. They worked really, really hard over the last few years to develop it. They bought it with about 30 lots, I think.
Yeah.
And built it up to 92, soon to be 95. Fully occupied it, improved it a lot. So they're just cashing out. They're ready to retire.
Any other questions for us?
Trip, if you were going to make up a question as an investor, what would you make up here while we're waiting for other people? Any questions you have?
I feel like we've covered all the big ones, hurricane risk, flood area, maintaining occupancy. Those would be my key questions.
Yeah, like I said before, part of the reason I added to the market demand slide that Trip showed and the one I'm sharing here is the thing that kept me up at night the most on this one is making sure we can hit 100% occupancy. I mean, obviously we've baked in 6% vacancy, but still have the high lot rent that we have here. And so we've spent a lot of time making sure that it's the right location, the right quality park, it's got the right amenities, and those will be things we continue to improve on as well. So I see a question about fund participation. So just to give some context, we have what's referred to as an open-ended fund that we started last August. And the way that works is we buy off-market assets like Ryan talked about before in the fund. And we only raise the money in the fund when we have an acquisition. So the goal with the fund is to eventually get to a point where all new assets will be 100% acquired by the fund. But in the interim, the fund will always participate in our acquisition. So we closed on our Missouri 2 portfolio in October, and the fund invested $200,000 into that. So it's benefiting from the cash flow from that portfolio. And then we are in this portfolio, in this RV park, we still need to determine the exact participation, but we're expected about $150,000 from the fund into this RV park. That would change if we have investors that are investing through the fund versus RV park. So you can choose if you want to join the fund to invest, or if you want to do just the RV park. And if you're interested in the fund, just let me know and I can kind of walk you through. We have 4 assets there now, so it's already diversified. This would be the 5th. Next question, Matt. This is a good one for you.
I can answer that. Yeah. Okay. Were the 5 new lots included in the underwriting? I would say yes, they were. However, I didn't like initiate them being rented until 2 months into owning the property. Our expectations are that the lots, when the property is delivered to us, those lots will be built and rented out. However, as a bit of leeway, I gave us an extra 2 months until we actually started collecting rent from those lots.
Yeah, and there I can actually say to you, they are almost complete, and they had their initial inspections yesterday, and they have another round of final inspections coming up in the next couple of weeks. So the seller fully expects them to be fully 100% occupied by the time we close. Good questions. Oh, I see more. I didn't scroll down. Darn it. Okay, one question. How does this compare to the mobile home parks that you manage now? So, you know, one thing that Ryan talked about here on site 13 is we have a lot of properties we're currently managing. Most of them are mobile home parks. This will be our 3rd RV park. This will operate much more similarly to a mobile home park than an RV park. And there's a couple of reasons for that. An RV park, you have to use special software for, because you need to be on the web, you need to be advertising heavily, you need to take credit card payments, you gotta allow self check-in, check-out, it's high quick turnover, all those things. This RV park is much slower than that. It's gonna be much more like a mobile home park where they're gonna talk to us at a time, we'll do background checks on them, they'll make a deposit, they move in, we'll be taking monthly payments, all those things with monthly leases. So very, very different than an actual RV park. So this is much closer to our bread and butter of the mobile home parks. Matt, is there anything else you would add to that? Cool. Okay, next question is minimum investment for current Suncrest investors. So our minimum investment is $50,000. I will say that there is definitely some leeway there on the minimum investment. The reason we have that minimum investment is because there's some complexity, based on legal paperwork, as well as just fund administration. And so we typically like to have a little higher benchmark, but depending on certain circumstances, we can go lower than that. So just talk to me, let me know what you're comfortable with, and we can typically make something work. Good questions. I'm not seeing any new ones come up here. Ryan, you have any you want to make up real quick, or anything maybe you think we didn't answer?
Yeah, I think the question for the mobile home parks, how it compares it, and this one operates, like our Crossroads RV Park in Fort Scott is a bit of a hybrid where we have a number of long-term RV tenants, but we have short-term weekenders as well. But on the long-term side, many of those tenants stay for several months at a time. And you usually have some warning. And as Matt was saying in Trip, there's a 5-10 to 10% wait list. When I called all of those other parks to get rent comps and just asked the question, hey, do you have room? And the ones that didn't, they basically laughed at me. Of course we have no room. And I said, well, do you have a wait list? No, we don't need a wait list. So it's, we're in that sweet spot where those parks are, as opposed to the ones further down that do have some vacancy, but Trip was alluding to maybe the quality isn't as strong as this one. So that might add a little bit more flavor to that question.
Great. Okay. Thanks for adding to that, Ryan. I don't see any new questions coming in, so we'll go ahead and wrap. Our team will stay on for a few more minutes in case others do have questions that come up. But in the meantime, really appreciate everybody's time and interest in this. Please do reach out if you have any questions. My Calendly link is always in our email, so you can schedule time with me. We will again share this recording tomorrow, as well as the full deck. We'll have our term sheet and the notes for the Q&A will all come out tomorrow. So don't hesitate to reach out with any interest. Thanks, everybody.